All right, welcome everybody. Happy Thursday and happy almost freaking August. Wild. So like I mentioned, we've got the legend Greg Hart here with us, and he's going to help us look ahead and beyond. Today, what we have is a halftime update looking into the second half of 2023. Also, we're going to be looking ahead at client markets that are going to be the hottest and coolest in 2024. And so Greg is going to provide a ton of data from PSMJ's quarterly market forecasts and benchmark report. He's going to provide insights for us just to look at critical trends that drive growth investments and strategies, strategic factors, emerging financial and operation trends, just a ton. So I did mention there will be a recording for anybody who needs to listen to this like 14 times because there's just going to be a ton in the next hour. So I plan on doing that. If you guys aren't familiar with Greg, he is a senior consultant and president of PSMJ. So he spent most of his career in and around this industry. But very interesting that he started his career as an environmental scientist, which you have your bachelor's degree in, right?
That's right. Yeah.
Yay. And then he also has a master's degree in business administration. So you're just making us all look bad.
Well, I try.
When do you sleep, by the way?
I don't know. I don't know.
So like he's done everything. We could probably just do a whole hour on your background. Just to touch, he's done business valuation coursework, M&As, ownership succession planning, business valuation, you name it, he really has done it. So Greg, if there's anything else on your background or bio you want to add, please take it away and dive in.
I think that was great. I think that you make me sound like I know what I'm talking about, which is fantastic. And if you listen to it 14 times, hopefully it's not because you fell asleep the first 13 that you're listening to it. But anyhow, thanks, Brittany, for that introduction. I hope it's a useful time that we have here together. There's a lot going on in the industry as far as data and trends, and certainly post-COVID, there's no shortage of people predicting what's going to come next, right? I've been hearing these expectations about a recession since we're in COVID, and knock on wood, so far they haven't really materialized of any significance. But looking forward, there's still lots of folks who see uncertainty, which rightfully so. I mean, there's a lot of variables, and we are still living, excuse me, in unprecedented times. None of us in our lifetimes have been through something like what we've been through in the past few years. So it's certainly hard to predict. I mean, the strain that pandemic put on the economy is huge. And what's really interesting too, by and large, the AE industry got really, really hit hard with the Great Recession. This, in some cases, especially on the architecture side, somewhat decimated. But by and large, it hasn't been at all the case with this current recession. So we're going to talk about that. I was thinking about a fun fact I could share before we get started, and I'm not very good with coming up with fun facts. But one thing I realized as I was getting on, I am like 3,000 miles down the road on I-90 from Seattle. So if you just get on I-90 and go 3,000 miles east, our office is that becomes the Massachusetts Turnpike, which is maybe a mile or so from our office. So we're really not that far apart, even though we're 3,000 miles apart. So there you go.
Not at all. Not at all. That's right after this. We'll hop on over.
I don't know why I didn't come over there, actually. I mean, it would have been easier. But anyway, I like to start with kind of what we're seeing out in the big headlines. And these are some headlines that I just grabbed from various news websites just this week. And what I think is really encouraging is that if I did this and when I've done this 6 or 12 months ago, even 3 months ago, that they were all negative, right? It was all doom and gloom, like I was just alluding to. But by and large, and at the beginning in the battle against inflation, right? Inflation is finally coming down, which is a welcome sight. There's news that the Fed might start to back off on some of these interest rate hikes, which is certainly a good sign. Economy avoiding a recession. Housing market, man, we thought, I mean, that was the one that everybody thought was just going to be an outright and full out collapse, and that doesn't seem to have been the case. But there is some negativity certainly in the office sector, and we're going to talk about that a little bit, because I think one of the big, I don't like to get too hung up on the macroeconomic headlines, because for a lot of us who work in small design firms, that it doesn't take much to swing us really far one way or another. It doesn't take a whole lot to make the difference between a fantastic, amazing, best year ever and a horrible disaster of a year. You know, a few big projects that come or go can have a big swing. And, you know, speaking of I'm in the Boston area, but you probably figured out by my reference to the Massachusetts Turnpike. We used to have a politician, Tip O'Neill, who said all politics is local. And I think that's the truth for a lot of design firms too. You know, all backlog and all economic factors are more local than anything else. So that's the big question we're going to talk about now is how does this stuff impact me in my firm, in my organization, or in our backlog? A little bit more background about me. Obviously, Brittany, I couldn't have said it any better. The way you said, I should add that the photo in the top right here is my pride of making my kids miserable by having to watch me finish a marathon, and they were just so thrilled when I crossed the finish line. As you can see, they just were so cheery, and it was just a big, you know, can we go now? Are we finished? Can we leave? And I'm like, you know, trying to catch my breath. But anyway, you gave a great recap. I won't talk a lot more about that. I certainly have been in this industry my whole career, and have been with PSMJ for the past 12 years, in a variety of roles. I was started as one of our consultants, business valuation, mergers and acquisitions, ownership transition, largely. I still do some of that work, but as happens with a lot of us over time, you know, I've done less and less of that and more general operational stuff within the firm. As you mentioned, I'm now the president, so that kind of shifted my role a little bit more, which started this year. But anyway, if you're not familiar with PSMJ, I won't spend a lot of time on this. I expect a lot of you are. So we focus just on the business of architecture and engineering. We don't get into a lot of the design technical stuff, but all the business stuff we do. So project management, business development, financial management, mergers and acquisitions, all that stuff. We have research on it. We have events on it. We have conferences. Hopefully I'll see some of you at our AEC Thrive conference, which is our big kind of flagship event in Salt Lake City in September. And we also have an advisory services business, all in the business of architecture engineering. We don't touch any other industry. We just, everything we do is focused here. So as Brittany alluded to, I kind of bucketed what we're going to talk about here into three things. I'm going to share a little bit of data, fresh data on where the markets are going. I think that's helpful for anyone to know, whether it's for recruiting, business development, financial management, mergers and acquisitions. I think this is stuff that I think is much more relevant than some of those big picture economic trends. Going to share some data also very fresh from our financial performance survey on some of the things that have popped out at me there. And then I want to talk a little bit. Everything we do at PSMJ, we like to leave you with things you can do when you get back to the office. Well, when you finish lunch, maybe in this particular case, but some specific actions and ideas that you can implement. We in everything we do, we don't want it to be kind of hypothetical fluff or big picture stuff that doesn't leave you with, we got to try that kind of ideas. So we'll end with that. So with that, we're going to talk about some data from our quarterly market forecast. And if those of you who are PSMJ Pro members, you're probably quite familiar with our quarterly market forecast, or maybe you've even participated yourself. So basically, the long and short of it, every quarter, we ask basically one question, which is proposal activity up, the same, or down from the previous quarter? And I don't care how you measure it. I don't know if it's dollars or number of proposals, whatever it is. We're trying to capture a basic sentiment of proposal activity. And it's been a really good indicator of where the industry's headed, because when you look at some of the billing surveys and things like that, that's what's happening right now. But proposals happen before everything else. You know, granted, not every proposal gets one, but the proposal activity we find has been a great indicator of ultimately cash flow. Now, granted, that could be, you know, a couple of years out by the time it goes from proposal to backlog to revenue to cash. But we find proposals are the best leading indicator you can get of where the industry is headed. So we ask this every quarter, and what we do is create an index. So if everybody said it goes from minus 100 to plus 100. So if everybody says proposal activity is up, then the index is plus 100. Everybody says proposal activity is down, then it's minus 100. And if it's 50-50, then the index is 0, right? So anything above 0 means more respondents are saying that proposal activity is up or down. So up rather than down. So we just collected this latest survey end of June, kind of into early July. So that's for the quarter that was just completed. And that's some of the data I want to share with you here. So this is the overall industry, proposal activity trends for the overall industry. Like I said, that 24.9 that you see for the recent quarter from a couple of weeks ago is good. It's positive, right? I mean, it's also rather quite stable. I was getting really concerned end of last year when you see that 8.0. That's when the Fed was really ramping up these interest rates, and that's when everybody was sort of thinking the party was over here for this industry. That all these record backlogs and all that kind of stuff that started 22 were cooling off. However, the good thing is here, it looks like there's been some stabilization. But what's really important, or what we look at much closer than this overall number. In fact, I had speaking of business school, so when I was in business school getting my MBA, I had a professor who talked about statistics, and he had said, on average, if I have 1 foot on fire and 1 foot in a bucket of ice, on average, I'm pretty comfortable, right? So that's now obviously we're not talking averages here, these numbers, but the point is true that just because proposal activity doesn't tell you a whole lot about decisions that you should make on acquisitions, strategic hires, opening a new office, things like that. But what I'd like to look at a lot more and focus on a lot more is these specific markets. So when we ask that question, we then ask the question specifically about these 12 markets that you see on the left side of your screen. These we find to be the most representative kind of 12 buckets of client markets. We also dig into 58 sub markets. Beyond that, I might have lied a little bit when I said it was one question. It's one question asked like a bunch of times over and over. But the long and short of it is, when you look at it this way, there's also an interesting trend when you'll notice that those markets that I have on the left side of the screen, they're not just in random order. They're bucketed by what you see on the far right side of your screen, which is the private sector markets in that light gray band, mixed, by and large, mixed markets, private/public markets in the dark gray, and then the public sector markets in the white at the bottom. And this is a trend we've been seeing for a while now, is that obviously, big infrastructure spending. I was at the AIA conference in San Francisco. When was that? The beginning of June, I think it was. And they had a panelist from the GSA, the federal government, and she had commented that it's rare that the federal government aligns with having both the money and the motivation to get things done. And that's what's happening right now. That you've got the money there and you've got the motivation, that those public sector markets are just on fire. So the red dot is where it was in the latest survey, and the blue dot was 1 year prior. So look at those red dots down the bottom for the public sector, continuing to be well into positive territory. Remember, plus 100 means everybody's saying proposal activity is up. And just in the past year, if you look at transportation, that plus 20.7 means it's up 20.7 points from the red dot from the blue dot, basically. But now let's look up at the top, because that's where we're really concerned, right? I mean, we thought for sure housing was just the bubble of all bubbles. Well, it might look like that here when you look at that red dot to the blue dot, but remember, I said that was 1 year prior. When you look at it to 1 quarter prior, it's actually stabilized quite a bit. And the fact that it's still up near plus 20 is amazing. And that kind of ground truths with some of the anecdotal reports, that general industry quote that I shared at the beginning. But even some of the architects that I'm speaking with regularly that are in the housing market, some project, there's always local hiccups. I mean, there's always exceptions, but by and large, it's not nearly as bad as they thought it was going to be. And things are going along pretty good, because we still have a lot of supply issues, certainly in some markets. demand still far outstrips supply. So the good news here, obviously, public sector market's on fire and will continue to be for a long time. The other good news, housing market, I think, is at the bottom. I don't think you're going to see housing market go much lower. If anything, it's kind of finding its way back up, especially if we see the Fed start to peel back these interest rate hikes. That'll help as well. Housing market has a, no pun intended, a pretty good foundation. The one you got to watch here, commercial development, is getting slammed. And I say that in a broad bucket of both retail, but the one that's really bringing it down is the office market. There's all sorts of different reasons for that. We'll get into it in a minute, but that's the market that if you're in that market, specifically the corporate office, tenant fit out, whatever you're doing, that market's in for a world of hurt. And we'll talk about that more in a little bit. But I did want to mention, so I talked about those 58 submarkets that we collect data on. The reason I'm pretty bullish on the housing market is one particular submarket that we see as the bellwether for not just the housing market, but candidly, a lot of other markets as well. And there's a submarket we call the subdivisions, residential subdivisions, okay? And if you look at that market, that was a great precursor to the collapse we saw in the Great Recession markets. Because think about it, residential subdivisions, when those are going up, there's demand for all sorts of other ancillary markets. So we need roads, we need bridges, we need courthouses, we need schools, we need police stations. A whole bunch of other markets are driven largely by what you're seeing in that residential subdivision market. So when you look at that data, and I'm just going to move my, whoops, hold on, I'm just going to move my little camera thing. When you look at that market, look at the rebound. Don't, I know the numbers might be hard to see on the screen, but the important thing to see is the trend, right? I mean, that market bottomed out 6 months ago. That's when we all thought for sure the residential market was just on the verge of complete collapse. But it has bounced back hard, or bounced back hard in a good way, I should say. It's looking good. It's back in a positive territory. When I see that and everything else I'm seeing in the housing market, that's why we're saying that housing market looks to be strong. Even if you look at some of these bigger home builders, the Toll Brothers and Lennar and groups like that, any index you look at for those organizations, so really good sentiment. This is one of U.S. home builders that show that things have really bounced back there. That is a market change from 6 months ago, as you can see on this index and see in our data. So all good in housing. I'm really happy with where that's going. But like I said, so that commercial development market has one particular submarket that's for office space, okay? And let's take a look at that. Remember, I just showed you the subdivision market, and I showed that bottom around -20, and it shot back up. Look at the office market, absolute free fall, -42.6 now. And again, remember, -100 is everybody's saying it's sinking. So it's at -42, and I don't see any reason why it would go back up. The big factor you have in commercial office is a lot of loans that came in a few years ago at, what, I don't know, 4% interest rates are now having to get repriced as they mature at, what, I don't know, 8-9%, something like that. On top of that, you have tons of excess supply in some of these major metropolitan markets, especially the cities that are very tech focused, that still have a lot of remote work. So there's excess supply, there's mortgage pricing pressure. There's just not, and I don't think, it almost seems that in a lot of ways, anecdotally, we're kind of stabilizing as far as sort of hybrid remote work. I don't see a lot of, I mean, obviously there's some organizations, big tech companies trying to push people back in the office, but that's largely to push them from fully remote to hybrid. You don't see a lot of orgs pushing from hybrid to fully in office. So I can't find much in the way of green shoots, if you will, in the office market. Office vacancy rates, this is from the National Association of Realtors. If you look at the it's probably hard to see, but way down at the bottom there, it's quarterly data. So the latest one is 2022 Q4. Those vacancy rates just keep going up. They just, and I'm continuing to hear stories just even within our industry of organizations that have decided to go remote. So the office market, if you look in that commercial development market, the office one is what's pulling it down big time. I don't want to make you dizzy here, but if we go back just to this, when I show you that commercial users and commercial developers are down, -8, -9, that's driven largely by that office market. In fact, if it wasn't for another secret market that's really doing well within that, it would be a complete disaster. And that secret market is this one here. Warehouse and distribution, which includes a little bit of light industrial as well, but it's within that commercial user and developer market, is doing great, right? 31.8, you can see on the index. There's a few reasons for that. We all experienced, I think, a lot of the supply chain issues that hit the B2C market, B2B market, anybody that relies on goods or goods, particularly in raw materials. So there's a lot of onshoring of warehouse and distribution that hadn't been the case before. And you look at even some of the bigger, semiconductors is in the chip manufacturing is probably a big example of one. But there's, Tesla, Intel, all these big blue chip companies that are building new facilities for either warehouse distribution or in some cases light manufacturing. That's really boosting that market. E-commerce exploded with the pandemic, and I don't think any of us on the call here today would argue that e-commerce is just a fad that's going to go away. So if you're in that commercial user and development market, if you can pivot into some of this warehouse distribution work, which there's a lot of adjacencies there that can be pretty attractive, then you're able to stave off some of the tremendous blow that's hitting and will continue to hit the office market. Another just a data point on this is construction spending on manufacturing in the United States, and the index or the axis on the left, the y-axis, is in millions, and it's just going through the roof. And look at that gray bar that you can see there is the recession, the 2020 pandemic-induced recession that was very brief, and it has just exploded. So warehouse, not as much as I say the office market is showing no signs of returning to growth, I would argue that the warehouse and distribution market is showing no signs of slowing down. And that market will continue to be hot. So that's a little overview of what we're seeing in the marketplace and kind of some of the trends in the proposal activity, which, like I said, impact backlog. I think public sector, the opportunities associated with infrastructure spending are here for probably the next 10 years plus. I mean, we could be in some of the best times of our lifetimes for market conditions there. I would argue the private sector is better than I thought and feared it was going to be, but that little office pocket is the one that's going to have a bit of trouble. So with that, I want to move on and share a little more data, because I just want to share as much data as I possibly can here in the time that we have together. So this industry nailed it. This is our operating profit margin on net revenue, according to our AE Financial Performance Benchmark Survey report. So that's basically operating profit, before discretionary bonuses, before taxes. That's a record, 20.1. Last year was 18.3, and it's never been this high. And there's a few reasons for that. As many of you experienced, and what I hear anecdotally almost every day is, 2022 was our best year ever. 2021 was our best year ever in some cases. And it's encouraging to see that, I think for a few different reasons, there's some sustainability here that's happening. And I'm going to share a few of those metrics in a minute. But here's a trend chart. I know it's probably a little tricky to see on your screens, but this gives you an idea of the context of where that operating profit margin on net revenue has been since 1999. And you can see just in recent years, it's ticked up a little bit. But there you go. That's our record, our high watermark so far of 20.1. So congratulations, and see if you can do it again next year, or this year, actually, I should say. One thing I should really point out here is that this data is collected on an annual calendar year. So that 20.1 is based on December 31st, 2022 year end. So the name of our session, our time together here implies halftime update. We're already halfway through 23. And I think anecdotally, I'm hearing that firms are expecting this to be a pretty good year too. I'm stopping short a little bit of saying a great year, but definitely a pretty good year. There's some headwinds. Wage expense has been a big issue, right? I mean, trying to keep up with inflation, as well as the talent crunch that's out there in the industry is putting some pressure. But I think what's really encouraging here is not only is the operating profit up, but there's a few other metrics up that show that this is a really good thing. This isn't just a fluke, potentially not just a flash in the pan. And in fact, I kidding aside about my ice, water, and fire on your feet from earlier, you have to be really mindful of that with stuff like this. I mean, so that the median, this is the median, I should say, by the way, too, is 20.1%. Well, by definition, that means half of the firms are below it and half are above. But even within your organization, you're probably seeing certain client markets, certain offices. There's still a lot of swing in profitability, but it is an indicator, I would argue, of firms commanding higher fees, which has been an issue for years in the industry, being able to justify raising fees. There has never been, we all experience this in our daily lives, that the inflation pressures that I commented on earlier impact this industry. Wages up 5, 6, 7% year over year. This has never been a better environment to get more aggressive on fees. Our industry has historically underpriced itself for a whole bunch of different reasons. But there's never been a better environment to push that a little bit, especially if you can deliver the value and articulate how you can differentiate yourself from the rest of the industry. Get away from selling time and more selling value. Labor utilization rate. This is a metric that we all track. There's obviously, if those of you are familiar with it, it's on a dollar basis, payroll dollars, direct labor dollars over total labor dollars. Now, it's a metric that can be manipulated a little bit. So I caution putting too much weight on this. This is actually kind of encouraging. I'm sure if you're not asking, you're thinking it right now. What is up with that trend downward over time? That's actually a really good thing. It's showing that the industry is changing, and it's relying less on people to do the work and more on tech, drafters, CAD operators, roles that we used to have that were critical to the organization. We've been able to become much more efficient on, even using technology from a project management perspective, has gradually allowed us to do more with less. And so that's why you're seeing this down. We're trying to, I look forward to the day when we don't even track necessarily metrics that are people-based like this. I think there will come a time when the question isn't who will do the work, but what will do the work, and that's a whole other AI, discussion to be had. But that's why you're seeing this trend downward in utilization. It ticked back up a little bit, but I wouldn't put a whole lot of weight in one data point on where the utilization is going. But what I do put a little more weight on in this people-based world that we live in is the direct labor multiplier. So this is direct labor dollars to total revenue, total net revenue, not gross revenue. And when I say net revenue, I mean, and this is relevant to the profit margin we talked about earlier, that's gross revenue less sub-consultant and reimbursable expenses. That's how we get to net revenue. I'm sure some of you, if you're primes or depending on your market, gross revenue can bounce up and down for reasons that are completely out of your control. I mean, pass through revenue. Net revenue is a more reliable indicator of true revenue. And look at that. So direct labor multiplier, so direct labor to total revenue, another record. We hit it out of the park again. And this is a good indicator of fees, right? Because if it's total revenue to your labor dollars, this shows where that upward mobility is happening on fees, which is fantastic. And that's why I say it's indicative of a more sustainable, not just a bubble of pent up demand or a bubble of more urgent COVID. I mean, of course, there were public agencies and airports and things like that took the opportunity during COVID to do work when travel was down. This is indicative that this might have some staying power. And I mean, it's funny. It just isn't that long ago, in the 2013, 15, 17, when every year it just seemed like it was 3.0, 3.0, 3.0. You know, that was just sort of the industry standard for direct labor multiplier. And that has really changed. As you can see here, even pre-COVID, firms really started to get aggressive. You know, another factor here that's hard to articulate or hard to quantify, I guess, is what I would call the kind of M&A/private equity effect. Firms that are owned by private equity or any outside investors are always going to have more pressure on profitability and revenue and earnings growth than firms that aren't. In private equity is just on a tear right now in our industry. And I think in a lot of ways that's a good thing, because it introduces a degree of accountability that didn't exist prior. And I think also with acquisitions, what we're finding is a lot of smaller firms, as they get acquired by more sophisticated buyers are looking at some of these KPIs more closely, and not just looking at it, but actually like doing something about them, and taking action and setting targets and doing all the stuff that any shrewd business owner would do. So that's probably what's driving the trend that started in about 2018. And certainly a factor impacting performance now. So it's fantastic. You know, we have a webinar coming up at the end of the month on July 26th, where my colleague Dave Burstein is going to dig in much deeper into that financial survey and what some of the underlying metrics are that are driving higher profits and what some of the high performance firms are doing. But in a lot of ways, it's not rocket science. You know, the high performance firms absolutely are getting more aggressive on fees, but not just arbitrarily. You know, they're focusing on markets that have a lot of growth potential, and where they can convey and deliver value. So in the time that we have left here, I did want to talk about some of those. Remember, I said at the outset, some actionable takeaways. You know, what are the high performance firms doing differently to beat? You know, when you look at some of those metrics, like the direct labor multiplier, again, these are median values. So 3.3, that means half of the firms. And by the way, I think I don't have the exact number. I think it's 360, 370 firms that participated in our financial survey. Half of those beat the 3.31. Half of them slated, you know, up north of 4 or 5. And that's the same thing on profits too. You know, it wasn't that the deviation was from 25 to 15, you know, it was from like 1 to 40 in terms of what firms are delivering on profits. How are they doing that? What are they doing differently? And I'm going to talk a little bit about that here. I would say and I've got 3 things, and I think I've got them in order of importance. I would argue that this is the most important one right here, is to price on value and manage on cost. And I understand there are some markets where it's harder to do that, some of the public sector markets, but be advised that if you're in some of those markets, expects the price you pay for being in those markets, it's a little harder to differentiate yourself. But I would absolutely argue there's some other real pros to being in some of those more commoditized markets. Some of those ones are the ones that get you through a recession. Some of those ones are the ones that always pay regardless of the economy. I had a retired CEO of a land development consulting firm I was speaking with a couple weeks ago, and he was talking to his leadership team, and you know, they're heavily exposed to some of the private sector markets, and they were telling him that backlog was up and demand was up and proposal activity was up, and everything was good. And you know, he was obviously concerned based on what we're seeing in some of the commercial markets. And his advice to the kids, you know, the current leadership team who's in place, was I think really astute, in that he said, be careful, they won't stop asking for work, they'll just stop paying for it when things start to slow down. And that's really true in some of those private sector markets.
Hilarious.
Yeah, right. So anyway, I point that up because obviously, you know, some of the markets where you can price on value the most have some of the highest volatility. But how do you do that? So here's some of the things that I see these firms doing that works really well. They make pricing a core competency. Okay, they designate somebody a chief pricing officer who's looking at pricing, who's benchmarking pricing, and who's looking at strategies to raise fees. Okay, whenever we ask, and this is whether it's in a webinar like this or in one of our conferences like our AEC Thrive conference, that's 300 AE executives, and we ask the question, who's raised fees in the past year? Lately, a lot of hands go up, and then we ask a follow-on question of keep your hand up if you regret doing so, if you lost what I would call kind of low-quality clients, and you'll never see a hand go up. Now, you might lose some of the clients you want to lose, right? You might lose some of the ones that are the pains in the butts, but they never lose a quality client. Set up a pricing plan. Look at where you're going to go over the next few years. Never give salary increases to billable staff without also looking at your billing rates, right? I mean, that's been a big issue for firms as of late, is they're facing this pressure to raise salaries, but not correspondingly raising fees, and in some cases, raising salaries pretty significantly. And I would argue that the ones that are on bottom half of that 20.1%, that's probably one of the biggest headwinds that push them down, is they haven't been able to or found a way to raise fees. And there are ways to use your existing clients as well to, they don't get the rate increase if they pay up front or find some other terms. There should always be a trade-off here. It's a negotiation as much as anything else. So find ways that if they do X, then they'll forego the raise increase, and there's some ways to get creative there. But the long and short of it is make pricing a core strategy, and don't just sort of wait and react, or I think fears that you're going to lose clients are oftentimes in your head bigger than they are in real life, especially if you can convey and deliver value to your clients. You're providing something that they can't get anywhere else, at least not at the level that you're providing. So, we've had this issue with recruiting as long as I can remember, in any economic cycle, maybe short of the Great Recession. Recruiting has been an issue in this industry, and I won't get into all the issues of fewer people coming into the industry, though that is certainly a big headwind. And the issue, I think, isn't so much a lack of people at the senior level. It's much more at the mid-level, what I would argue are the Gen X level, and maybe at the millennial level too, because you have a little bit of an issue there if they have left the industry. The ones who got hammered in the Great Recession maybe went into software, real estate development, some other adjacent or near adjacent or not adjacent at all market and industry rather, and haven't come back. But the key here with recruiting is to not just sort of look at it, not to look at that nail with the same hammer that we've always looked at it with. And there was a time, when the pandemic first hit, I think a lot of us thought, wow, this is going to really hit the brakes on the war for talent. And it maybe did for like a month, it did very briefly, but geez, that popped back stronger than ever. And there's always going to be this issue. It's never going to go away if you're just doing the same stuff that everybody else is doing to recruit talent. So a big one that some of the high successful firms, high performance firms have started to do in certain markets is not require that a project manager always be an architect or engineer. I mean, there's always been this age-old wisdom that you sort of start out as an entry-level engineer or architect or scientist or designer and move your way up to level 1, level 2, level 3, and at level 4 you become a project manager. That's like the natural progression. And there's a firm that killed it on our Circle of Excellence, which is the top 20% on 12 metrics in that survey that I shared earlier, the financial survey. So the Circle of Excellence firms have reached the top 20% on profit, utilization, direct labor multiplier, turnover, being the lowest turnover, and some other balance sheet metrics. One of them in particular points 100% to their success being they got out of that traditional mindset and hired folks who were truly project managers, and schooled in project management and had to learn the industry. There's also a lot of stuff that we put on technical professionals that could be put off to others, attending planning meetings and things like that, that you can hire paraprofessionals for, and free up your technical folks, your project managers and others for real higher value tasks. Some firms are doing fantastic stuff with reaching deep into the community to build a pipeline. I saw a session when I was at AIA in June with the Detroit office of AECOM that started an internship program specifically for students of HBCUs, historically Black colleges and universities. And it's more than just a traditional internship. There's a specific project that they find with the community in Detroit. And in this particular case, this previous year, it was like a athletic facility for the community. And that group of interns, and they provide housing and all this other stuff, goes through the design process of this one project for the whole summer. And others are even reaching down to the high schools and doing some other creative things. But in particular, this program I thought was really neat because it tapped into obviously a bigger DEI issue that we've had in this industry for a long time, and really looked at underserved communities. And it was really interesting too, because the executive who kind of sponsored it in the AECOM had said he was, like a lot of us, I guess, that this happens, is kind of hits you. Ideas and inspiration hit at the most random time. And he was on vacation, down in the Caribbean somewhere. And I think he'd said, he's an architect by training, and had commented that up until that point in his career, he thought sort of the legacy of his position as an architect was the buildings he's designed, and, seeing the community and the buildings that he's built. And he said, it just hit me that it's not that at all. It's the people that you've built. It's the people that you've developed to carry the industry forward not long after you're in it. And that was the impetus for starting this internship sort of scholarship program, as well, to tap into some underserved communities. It was just fantastic to see in the room some other folks kind of scribbling down notes and thinking about how they could do that in their design firm. So think about things like that. What makes your internship program different? And how does it create opportunity? And it doesn't, I thought was really interesting is this is AECOM, right? One of the biggest firms in the industry. But there was a fellow in the group who had, I think, like a 9 or 11 person design firm in Harlem. And, they were talking about how he could do something, even with 9 or 11 employees, how he could do something very similar at a smaller scale in his community. So it was just fantastic to see those sorts of ideas that are very non-traditional, or haven't been the norm for our industry. Referral bonuses are always going to be cheaper than recruiters. We did a survey. One of the most common questions I get at PSMJ: do you know a good recruiter? Just constantly. I don't think a week goes by where I don't get that question. And the reality is, there isn't one. I mean, the reality is, look, recruiting is a very fragmented business, and there isn't a lot of kind of good recruiters that serve the whole industry. They might just be in Seattle, or just be in New York, or just be in Miami. But the reality is too, I mean, referral bonuses, and when I say referral bonuses, I mean to your existing staff, to recruit their friends, colleagues, former coworkers, things like that. Whatever it is, not double it. It's still going to be cheaper than a recruiter. And those, there's an endorsement value that comes when it's a existing employee who's recruiting folks. But then with the more, I think one of the issues I hear quite a bit is at that Gen X level, who is the current kind of or soon to be next generation leadership and ownership in the firm. And those you have to target with a little more of a specific approach. And some examples I've heard along that, or they kind of ask each of their managers to make a short list, a wish list of folks who from your career, competitors, former college classmates, former coworkers, who would be fantastic to have on the team. These are the all-stars. And if everybody writes down 5 of those, suddenly you've got a list of 25 or 30 people. But what they did, this one firm did that was quite different, I thought, and very effective. They didn't go at them with the recruiting message. They didn't hand it over to the HR people to start recruiting. They handed it over to the marketing people to start making sure that these folks got all of the promotional pieces on projects that they just completed, and things like that, to create more what I would call pull-through marketing. That the idea was these folks are going to start seeing, wow, that firm is doing some really cool stuff, rather than just hitting them with, hey, come work for us. And that was an effective approach at that senior level, at that executive level. So the long and short of it, and I know this session isn't all about recruiting, but that is the key to growing revenue, to growing sales, to being sustainable in the economy. And my point here is just that there are things you can do that are different than what everybody else is doing. When I hear frustrations about recruiting, it's often followed up with, when you dig into it a little bit, what are you doing differently? What are you doing to make it work? They're doing the same thing every other firm in their market is doing. They're putting a job post on LinkedIn and getting lousy candidates. So there's something you can get creative on that and think of it much more like a marketing exercise. The other thing that's a bit of a common theme here with our high performance firms is they're very intentional and strategic about their growth. I don't think a single one of those circle of excellence firms would ever say it just happened. We grew just because we were in the right place at the right time. Even if they say that, it's just because they're being humble. And this industry has a tendency to be very humble. The reality is they're doing several things really, really right. And that usually involves, the employee engagement experience, the client experience, and all of that. But it also means they're being very intentional about strategic planning. And that was one of the things that certainly in the Great Recession, and even in COVID, and kind of in COVID in 2020, there's or two who comes out here is strategic planning dead. And strategic planning traditionally, right, you're looking 3 to 5 years out, and looking at where you're going to move and shake and invest and allocate resources. And when we were in 2020, there was a period, right? I mean, we didn't know what was happening next week. How could we figure out what was going to happen in 3 to 5 years? But what the successful firms were doing in that time? They were doing what I would call scenario planning. Worst case, most likely, and best case. And always staying within that envelope and moving and adjusting. So we did a study. We tried to quantify this a bit because it doesn't make it's not really actionable for me to tell you that just come up with a strategic plan. That's what's going to, how do we start? What are we supposed to do? So one of the things that you've probably learned about PSMJ in the past 45 minutes, if you didn't know already, we're very, very data focused. We don't want to just talk about common practices. 82% of firms are doing this, 46% of firms are doing this. We try to really isolate the best practices. So what are the high performance firms doing? What are the most successful firms doing? And here are we did a study on strategic planning a few years ago, and here were some of the things that they were doing that was pretty unique. They don't look at employee satisfaction, they look at employee engagement. You can give your employees a bunch of big raises, give them pizza on Fridays and all sorts of other fringe benefits, and they'll be happy, but are they really engaged? And we've had some discussions about this in our PSMJ Pro monthly executive briefings, and talk about, what does engagement mean? There are things like doing work that matters, okay? Being a part of the community, feeling like they're really contributing to the organization at a higher level, feeling like they have growth potential in the organization, really, really doing research on that and how engaged your employees are. And there are surveys, we do them, other people do them, that you really got to measure that versus just some of these best firm to work for contests. Typically, it's about 20 or 50 hours. It varies a bit for everybody involved in the strategic planning process. 50 hours for the one who's kind of leading the whole charge, 20 for those who are just more like participants of the meeting. But everybody should expect, who's involved in the process, 20 to 50 hours. Huge, huge, huge mistake that a lot of firms make is not inviting some of these next generation rising stars. It's really, really eye-opening sometimes when you have some of your younger folks involved in some senior level discussions about strategy and growth. And they just will bring up ideas and questions and thoughts that nobody else would. So tap into that and do it in a way that's productive, that gets them feeling like they have a voice. Don't just ask them what we should do, but really understand what they see as the opportunity and what they enjoy doing, and where they find value. External facilitators is another thing that was pretty common. Without that, my experience has been that strategic planning can devolve into kind of operational management kind of discussions and not real strategic issues. And I think too, as much as the plan is 3 to 5 years out, the successful circle of excellence firms are still revisiting the plan in a more formal offsite way every year, and that it probably is more important now than ever, because we are still in kind of uncertain times. As much as I say everything's looking pretty good unless you're in the office market, there's still tons of wild cards out there. We could get in a war with Russia or China or all of the above, and everything could change. There's so much going on out there, that could still have an effect. And the reality is that's always going to be the case. But if you're meeting annually, and the key here is to do that as a real offsite retreat, even if it's a 1 day, an annual check-in. Put your phones away, put your laptops away, and let's talk, and let's have a discussion about where we're going here. That's another very simple but common trait of the high performance firms when it comes to strategic planning. They don't just develop the plan and then walk away. So anyhow, I hope that was all helpful. We covered a few different things there. So we started with the quarterly market forecast data, look what's going on in the industry. Then shifted gears a little bit to what's going on at your firms with some of that financial data. And then wanted to leave you with, if you want to beat some of those numbers that I shared, if you want to hedge on some of those market conditions that we talked about, what some of the strategies are that successful firms are doing. We call it the halftime update. Like Brittany said, we're already almost 7/12 of the way through at this point of the year. This has been a zippy year. But anyway, I hope that was helpful. And I think we have a little bit of time if there's any questions.
Wow. I just want to say I love where you started and where you ended that. Like the second half of the half time update is so relevant to everybody. So, which is an amazing job, first of all.
Oh, thanks. Thank you.
You can breathe now.
I know, right? Yeah, exactly.
So yeah. I haven't seen any questions in the chat yet. Does anybody questions, comments?
I'm also just curious, is there anything in there that you're not seeing in your firm or that's inconsistent? I'm always interested in hearing from folks saying, believe it or not, we're in the office market and it's humming for us. Anything like that?
Good question. Harry, you have any comments?
Looks like we got a question there about the school bond market. I don't have a whole lot of insight in that one. I don't know if anybody else here has some specific
yeah, I was just kind of curious because of course they all went real quiet during the pandemic, and a lot of things just kind of got paused. And I was wondering if you'd had any, if you had any insight yet on what schools with changing and enrollments and online schools, like all that. I wonder if you have any insight on what that might be looking like.
I mean, the tricky part with that, obviously, that is a very local issue and depends on the specific market. But by and large, the folks who are in the schools market, K through 12, we're talking K through 12 really specifically here, have been reporting really, really strong conditions. And there was, you're right, some uncertainty, in the pandemic. But I haven't heard any big issues of things kind of grinding to a halt there. So by and large, I'm hearing, and I can even look at the K through 12 submarket while we're let's see what we're seeing in that. It looks like I think another question came in whilst I'm.
That's a good question. I was going to ask that too. Looking like ranges for referral bonuses.
Yeah, so we're actually going to be, our next survey that's coming out is our bonus and benefits survey, which will have the updated data on that. And again, just like that financial survey, it's based on December 31st, 2022. So I would argue this is probably going to be even skewing up a little bit. But historically it's been, I think, and that's a survey we do every other year. So the last edition of it was 2021, which was collected as the end of 2020. And it was usually, I think the median was about $2,000, something like that. And I would say double that anyways. Yeah. Now, important to remember, those should have some strings attached. So number one, at the very least, 90 days, right? They have to be there 90 days and get a satisfactory sort of initial performance review. So it doesn't get paid out at the day of hiring. It gets paid 90 days out, subject to satisfactory performance review. And then it does get paid out. I wouldn't do it in installments or anything like that. But I would bet it's going to. My guess would be the next survey the bonus and benefit survey that comes out in a few weeks will have it probably at 2,500 or something like that. But yeah, I would get even more aggressive than that. And depending on where your needs are too, I've seen some firms that if it's a really hard to fill position, they'll do 5,000, and if it's a easier position, they might do 1,000. That there's a little bit more of a scale. They don't just have a kind of uniform for everybody.
That's how ours are. Yeah, there's kind of a scale. There's kind of a scale on urgency and position, and
Totally.
but it's always cheaper than a recruiter.
Oh, no doubt.
Always.
Yeah. Always.
And just more effective too. It's not often that you'll have an employee recommend somebody who's just a complete dud, right? I mean, it's just going to be more effective. So I'm gonna share. Let me just get it so you guys can see it. I got a lot of windows open here. Hold on here. So I'm gonna share that quarterly market forecast data for. So this is that you might not be able to see it, but you can see the red bars. At least I'll zoom in even more. This is the K through 12 market. So it's been pretty on fire. This is the K through 12 submarket of the education market. I don't know if you can see numbers, but 43.2, 42.9, and pretty stable too, all the way back to the pandemic. I mean, obviously this is where we had the world kind of shut down, but it bounced right back, and pretty stable in the 40s. So, but this market definitely is very subject to local forces, municipal bond issues, and things like that. Yeah, good. Anything else?
I was curious. I don't know that I've seen it in anything yet through the membership, but what are some questions that you put on the engagement survey, or kind of what's the process and recommendation for that?
Yeah, it's very much about your perception. I think the biggest difference is it's your perception of the firm. So it's not questions about your satisfaction per se. It's questions about, my firm has a clear vision. My firm takes DEI seriously. My firm invests in tech and innovation. I mean, there are some questions about your personal, what I would call work environment, but it's very much my firm investing in talent. My firm gets rid of underperformers. It's very much, it can be very much an indictment, on the management team to some extent, when you're asking questions like that, which are very much about your perception, which is really all that matters. I mean, even if you, and this happens, right? I mean, managers say, oh, they don't understand. It doesn't matter. The reality is that's their perception. So it's questions like that. The one that we do is, I don't know. We just made some edits. It's got to be 75 questions, something like that. And we just added more questions about things like DEI and community involvement and that kind of stuff, because more and more on the strategic planning front. So we do strategic planning as part of our consulting business, and we're having leadership teams come to us about strategic planning, and they're not as interested in how do we double in the next 5 years. They're really not. They're interested in how do we have an impact on the community and kind of leave the firm better than we found it. And it's stuff like that, because they realize that's what their employees want too. They're just, And that's, I feel like I've noticed that just in the past 10 or 15 years, there's just less grow and profit and more focus on this. But lo and behold, look what happens when they focus on this. Profits are at 20.1% at a record high. So you know, sometimes focusing on the number isn't as effective as focusing on some of the impact the firm has on the community.
Yeah, I mean, we've got a 12 question one that's got a couple of similar questions. And so we do monthly check-ins, but I'll send those quarterly, and we kind of keep it 12 and a larger one at the end of the year. But definitely seems like people are looking for a lot more purpose in a post-pandemic world. And they're just like, I don't care how much I get paid. I just want to do cool projects, and I want to develop and say yes to all education and conferences. So yeah, I agree with that.
For sure.
Well, we are now at 1 o'clock. Does anybody have any questions? I'm sure everyone thinks you did an amazing job, Greg. So I'm definitely gonna try to steal your time again in the future, because that was
time. Yeah. And by the way, too, if anybody wants a copy, so there's a report that we publish that has all, it's the quarterly market forecast report. That's, you know, our PSMJ Pro members get it all the time, but I'm happy to send you a PDF of it. Just ghart@psmj.com. Given that I spent like a half hour talking about it, it probably would give a lot more context if you saw the report. So and it's pretty, I don't know, I feel like you already know, you have a good idea of how the index works, so it'll be pretty easy to read. But if you want a copy of that, just shoot me an email and I'll send it along for sure.
That would be amazing. When I send out the PowerPoint and the recording, I'll put your email and just mention to reach out to you.
Yeah.
And then I'll reach out to you separately. I didn't know that you guys did succession planning, so that would be kind of cool. So anybody who wants to hire them, we're clearly.
That's a big right now. Yeah, I'd love to talk about that sometime too, because that is, I would argue, the biggest existential question that firms are asking themselves right now is who will run the firm tomorrow. You know, it's what's been really interesting though is while we've been talking about this bubble of retiring baby boomers for years, that it's coming. It just sort of happened over like the past 6 or 12 months. And we had our merger and acquisition conference in December. And there were so many people I met there who I recognized the firm name. And when they'd introduce themselves as the CEO or president, then they'd be, you know, 40, 45, 50 years old. I'm like, I've never met you before. You know, I'm so used to, you know, the person before you. And so it just happened. I feel like 2022,
they just
maybe there could have,
they did.
Yeah.
kind of, yeah. I mean, I guess there was probably a little bit, like you just alluded to, Ricky, like post-COVID, people kind of realize, you know, nobody lives forever, and it's time to sort of, you know, make it happen. And also, too, I think there are probably a lot of Gen Xers who are like, you know, it's going to get out of the way, or we're just going to be stuck in this forever. So, yeah, it just happened. Like within 6 or 12 months, like boom. So there's all these new owners, but there's still a lot of firms that are struggling to
I
address
can't
that
believe how many retirement announcements we've gotten in the last
Oh,
18
yeah.
months. It has just been one after the other, and it is a lot of founders. It's a lot of firm founding you know, owners and higher ups, and it's just like, oh, there goes another one, there goes another one, and it's just like crazy.
Yeah. What's exciting, and I know we got to go, but what's exciting is that what I'm hearing from a lot of these folks is they want help figuring out how do we like preserve the legacy, right? We don't want to like screw it up. We want to preserve some of the culture that got us here, but embrace digital transformation, innovation, you know, all the stuff that has the potential to really turn our industry upside down. So they're kind of trying to figure that out. How do we not just like throw everything away, but throw some stuff away, you know, gotta get to the.
Yeah, it's very exciting.
Yeah, for sure.
Was that the ROGS conference in November? Right.
So we started a merger and acquisition conference last year that was in December in New Orleans. It was like the first week of December. And we just had been getting more and more questions about merger and acquisition, and thought, well, why don't we have a conference on it? And it was amazing. It really was. So This year it is in December again in Scottsdale, Arizona. But it's all, it's a mix of people buying and selling and investing and all that kind of stuff. But yeah, just a fantastic event last year. Lots of good. It really attracted a lot of these next gen leaders wrestling with some of these issues.
And for anybody in finance, they have amazing boot camps. I'm about to do the one in October, but they also have online and they have in person. So definitely check it out because they are jam-packed with good information. Yeah,
thanks. Appreciate that.
Well, cool. Well, we don't want to keep you too long. We want to respect your time. I can hang out with you all day. So thank you so much.
Thank you very much.
You are amazing. Hope we're definitely going to try to steal you again.
Anytime.
All right, everybody. Have a good rest of your week. And I put the links to the next ones in the chat. And we'll see you at the next one. Bye, Greg.
Thanks everybody. Bye.